Hello and welcome back to Buy Now, Sell Now. You're watching ET Now. We're now joined by a very special management. We have Sanjiv Chadha, who's the MD and CEO at Bank of Baroda. Good morning, sir. Thank you for taking out the time to chat with us. Let's begin with your quarterly result. There's been a sharp bounce back from Q1. That's evident to anyone. The earlier pressures around the cost of funds also seem to be ebbing off. So what were the key variables that played a role to a decent show in this quarter as you see it?
Okay, so I think if you look at the current quarter, I think the key issues have been in terms of the net interest margins, which had come under a little bit of pressure over the last quarter. And our cost of deposits was something which had not fallen in line with the falling yields in a market of declining interest rates. So I think that's something which has changed in the current quarter. Our cost of funds has come down by 53 basis points. So that's something which has really been the biggest factor which is responsible for the input in the net interest. On the asset side, the growth has come from the retail book. So unlike the corporate book, where the large amount of liquidity which has been sloshing around in the market has meant that the best rated corporates actually are commanding very, very fine pricing. The retail book tends to give a very steady return. So the fact that our growth in terms of assets has come mostly from retail has helped. Our home loans have grown 13% on an organic basis, education loans again by 13%, car loans by 35%. I think that's what's helped keep the yields up. In terms of deposits, the fact that growth came from CASA has been a big help. We reduced our savings bank rate, we reduced our term deposit rates. Despite that, YOY our CASA has increased 12%. Retail term deposits have increased 9%. So I think the key highlight in my mind has been not only the growth, but the growth. The fact that the improvement in cost of funds has come from a larger CASA deposit, the fact that the improvement in loans has come from retail loans. I think that's, to my mind, is a key as far as we are concerned of the current quarter. The second point I would like to emphasize is that there's been a very sharp rebound as compared to Q1. While we have had a YOY improvement, which in itself is significant given the times that we live in, on a YOY basis, the operating profit is up. But I think the rebound from the first quarter is what is really important. Our recovery, our fee income that had taken a big hit in the first quarter because of the lockdown, that has rebounded sharply. Even in terms of our loan disbursements, there's been a big improvement. In fact, our loan disbursements and our loan sanctions in Q2 are higher than they were in Q2 of the previous year. And this is despite the fact that a significant impact on the economy still persists. So overall, I think there's reasonable amount of satisfaction in terms of the improvement we have seen as compared to the first quarter of the year.
Right, sir. And the provisions have been significantly stepped up. So, could you share your thoughts on the current coverage ratio? How well have you provided for the potentially restructured book or book that will require restructuring?
So if you look at our corporate book, that has been really the reason why we have had a few bad quarters, a few tough years in the past. But at the end of it, if we see our provision coverage ratio stands at 85%, which means in terms of what possible impact historical stress could have had on the book, that's largely played out. At the NCLT book, in fact, that's provided up to 90% or more. So when it comes to historical stress, I think we are in a reasonably good place. The question, of course, is what is likely to be the COVID-related stress and how is it likely to play out in the future. So there also, I think we have some room for guarded optimism. So in terms of the RBI dispensation, there is about 14,000 crores of loans which had not been classified as NPAs because of the moratorium benefit which is available. Now, as far as that 14,000 crores is concerned, it could play out three ways. There could be upgradation, and in fact, there has been significant upgradation. There could be restructuring, and there could be some slippages. So currently, as against that 14,000 crores, we hold a provision of 1,700 crores. So if you were to assume restructuring as the central possibility, restructuring requires a provisioning of 10%. So we are more than provisioned for taking care of that book as far as the impact on provisioning is concerned. But having said that, I think we must hold our judgment for till the end of December, by when we will know what accounts have slipped to NPAs, what is the extent of restructuring. But I would only venture to say, in terms of what our prognosis might have been 3 or 4 months back, in terms of how many clients might have a request of restructuring, I dare say it's likely to be of a significantly lower order. But then again, we need to suspend our judgment till December, and let's see how it goes. But in terms of the resilience of the balance sheet, given the provision coverage ratio and given the amount of provisions we hold against the book, which would have fallen to NPAs but for the moratorium, I think we are reasonable.
All right. Could you also talk to us about your guidance on growth? While we are largely covered, what is your guidance for FY21 and even 22, if you could give us some projections on growth, profitability and balance sheet strength?
I think we have largely covered what is the likely scenario. We should see cost of deposit remaining very competitive. We should see loan growth to be driven to a large extent by retail and by agriculture in particular, both of which have seen about 16% loan growth. In terms of asset quality, it is tough to hazard a guess in terms of where the restructuring is likely to be, but regardless, I think the bank's balance sheet seems to be strong enough on account of a provision coverage ratio of 85%, and because of the fact that collection efficiency is back to very near normal times and is about 90%.
All right. Thank you so much, Mr. Chadha, for joining us and talking to us about Bank of Baroda's numbers and the way forward. Let's quickly pull up the market.